As a trader, you would have heard that if you can trade a $100 account, you can trade a $1,000 account. If you can trade a $1,000 account, you can trade a $10,000 or $100,000 account. The only difference is just your capital. Successful traders know this, that what matters most is the discipline to keep repeating the process that has been working. So if a process is working with a $100 account and you repeat that process for the first month, the second month, the third month, and you can repeat that process for 6 months, you are making money consistently, then you can do that with a $10,000 account or a $100,000. Now, how can you do this? Risk management. I'll talk about risk management before I talk about strategy or trading plan. But you need to understand that your risk management is far more important than your ability or your strategy or you being the best in whatever you do. If you are not disciplined to keep to proper risk management, it will be difficult for you to keep to proper risk management when you have a larger account. When I say risk management, I mean you need to know exactly how much you are going to risk every day you come to the market. You need to know exactly what percentage of my capital am I willing to give up or am I willing to lose so that I can gain more. Now, most traders use between 1% to 3% of their account. Personally, I use 1 to 2% of my account, and when I trade, what I also do is my maximum drawdown. And maximum drawdown means how much am I willing to lose before I stop for the day or before I stop for the month. Now, in a typical day, if I make 3 attempts and I lose 3 of them, I'm done for that day. I walk away and come back the next day. That is maximum drawdown. So that means I'm risking just 1%. If I lose the first one, I have 2 more chances. If I lose another one, I have 1 more chance. So you need to know how to calculate what is 1% of your account if you are going for 1% of your account. And if you are going for 1% of your account, you want to know that is that the max you are going for. You don't want to go for 1% and still be trading when you've lost more than 1%. If you lost more than 1%, it needs to be clear that you are done for that day. Now, as well as knowing your risks, you also need to know your risks to your reward. This simply means that if you are risking 1% of your account, you want to know how much you should be going for. You should be going for 3%, 4%, depending on the kind of trader you are. But what matters most is understanding that the market does not just go in one direction forever. So you can't allow your TP just to be rolling forever. You should have a clear TP. You should know that you are not the owner of the market. You are just there to take something. And if you get that something, you walk away and come back the next day to try again. Always go for a good risk reward, because the day you win 2 or 3% or 4%. The day you lose, following good risk management, you lose just 1%. You don't want to shift your stop loss. You don't want to remove your stop loss. You don't want to say you're not putting any stop loss, or you don't want to use a lot size that is more than 1% of your account. Now, this is where the law of compound interest comes in. So if you start with $1,000 or you start with $100, now if you use 1%, by the end of the day, the next day you're not going with $100, you're obviously going with $130 if you win. By the end of the week, you are obviously not going to be in the same place as you're having $100. Now, when you understand the law of compound effect, it helps you know that you're not thinking about today's trade, but you're thinking about the process. Keep following the process and your money will keep growing and keep improving. But to achieve all this that we've been talking about risk management, let's start with the basics. Having a strategy, a trading plan, and understanding your kind of personality. So how can you build your small account into a large account size? Now, the first thing you need to work on before you start trading is be sure about your strategy. I don't call it strategy anymore, but as a beginner, you call it your strategy. But what matters most is your trading plan. Now you should be clear on what your trading style is, your time frame, your session you'll be trading. Now you also have to consider the pair you trade. You don't need to trade all pairs because forex or the financial market gives you the freedom to trade anything, but you want to narrow it to 1 or 2 pairs that you are skilled at. And the point is, you want to make money. If Emeka, Kunle and the rest are making money with gold or with NAS, and you are good with just your Euro USD, stick to your Euro USD. As long as you make money from it, it is the same thing at the end of the day. So don't get caught up in that circle. Now the second phase has to do with reviewing your trades. Now when you start trading, you will likely see that you are making more loss than you are making profit. It is normal because you are just starting, and your job in this phase is to find out what your strengths are and what your weaknesses are. So that's why you need a trading journal to review your trades. You want to see as a person, if I trade this time, if it's the London session, what is my win rate? If I trade the New York session, what is my win rate? Then if I use this trading style or this trading strategy, how good am I? Does it work for me? So you need to check your strength and you need to compare it with your weakness. Then in your review, after like 50 trades or more, you want to check what is working and stick to that part. For me, for example, I noticed when I was starting earlier on that I wasn't good with the London session, but I was very good with the New York session. Until date, I trade only the New York session. It doesn't mean I can't trade the London session or I've not improved, but what gives me results is still the New York session, and I stick to what works for me. Now, part of the first step is backtesting. So you want to backtest your strategy before you start. And now people use demo trading, some people use simulators, some people use TradingView and just backtest. They replay their strategy. And the aim of this is that you want to make all the mistakes, make every mistake as possible. A demo account will always be a demo account. You can blow as many, but refine your strategy. Be sure about your trading style. Make sure that you understand it clearly before you start with real money. The third stage is starting small. Now, when you are starting out trading, your job is to find your trading style. You want to know, you will make a lot of mistakes, so you want to know what is working, and it will take time. So in the phase of finding out your trading style, when you start seeing what is working, you start sticking to what is working, then stop doing what does not work. Now in the process, what you want to do is use a small amount of money to trade until when you are consistently profitable in that small account. So in summary, to grow a small account, you need to focus more on your process, your style of trading, and be consistent with it for over at least 6 months. If you can do that consistently, you are seeing profit consistently, then go for a higher fund. Look for funds from companies that are willing to trade or give you funds to trade, or look for individuals who are willing to invest in you.